All right, guys, welcome back to the Educated Home Buyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. My headphones are not working well here, but it's all good. Let me know if you guys can hear me out there. I'm having a really hard time on my side hearing if I'm actually coming through. So let me know there. Also, let us know where you're watching from. This week, we've got our one and only Josh Lewis back, resident mortgage specialist, expert, all things mortgage. I don't know, finance.
Hey, don't you're pigeonholing me. There's lots of things.
Oh yeah, there we
Yeah,
go. There's the sound. It came back in my headphones. We're good.
I was going to tell you, I hear you just fine. So
Perfect.
that's all that matters, right?
Well, I mean, partly, yeah, but there's also people here that want to listen. So, so what's
Oh,
happened
that-
this week with regards to housing? We got pending home sales today, down 1%. I don't think there was any surprises there. I think the biggest surprise for a lot of people is going to be the fact that Lawrence Yun, chief economist for our National Association of Realtors, basically thinks that maybe there's a bottom with regards to inventory for this year. We've talked about inventory over the last couple of weeks. In fact, I kind of told you a couple of weeks ago that I thought maybe we had seen the peak in inventory, at least here in Southern California, just based on numbers declining. So last week we came on, I think we had 4,000 and something homes here in Orange County. Today we're sitting at 3,863. So instead of adding inventory week over week, we've actually declined. Huntington Beach, my market, same thing. We've lost about 16 properties over the last week. Now, Josh, you and I have talked about this. Part of these homes are going into escrow. Part of them, homes are sitting on the market and sellers just said, screw it. I guess I'm not a seller. I'm not getting my price. I'm backing off the market. And that's another piece of it.
So yeah, we talked a lot about that as the market shifted.
You're not coming through. So I can't hear you. Can you guys hear Josh? Can you hear Josh? I can't hear Josh. He was yelling at the camera and he didn't come through. While he tries to figure that out there, mortgage applications declined.
Jennifer says she hears us both. I think we're going back to your headphones.
You can hear. I can't hear you, buddy. So, but it's all good. Do your thing.
This could be hard to do a show.
This is like something's going on. Now I got you, bro. Somebody screwed with the mic. Oh, you been in here playing with my mic, bro?
Yeah. No one's played with your mic in years.
Oh boy, here we go. All right. So so we talked about what were we talking about? Inventory declining. So what are your thoughts on that?
So again, this is not I don't want to say good or bad. Like so much of what we comment here is making qualitative judgments about what's happening. Sometimes things just are what they are. We had a great or an awful 2 years, depending on who you talk to. So mid 2020 through early 2022. 2 hot, crazy years. If you owned real estate, you were stoked. If you bought real estate early, you got an awesome rate, you were stoked. You were frustrated and angry when you were getting beat out and having to bid against cash offers and multiple offers and all that stuff. So it's important to remember that a much more normal market, still seller's market in most areas. So again, Jeb and I, our context is California, specifically Southern California primarily. Mm-hmm. It is still a seller's market. Desirable properties get multiple offers. Jeb, you have a client that's been looking for a year and really close, and they're still back and forth. The seller's just not like, yeah, offers. Fantastic. Yeah. Thank you, Jesus, that you wrote an offer for us. So it's important to remember that instead of panicking and freaking out, this is a more normal market and still a seller's market. So when we look at inventory, this was what I predicted earlier in the year, a version of this. You know exactly how it's going to play out. But you say at a certain point, if rates continue to go up, we lose demand. We talked about willing and able demand, lots of willing buyers. My phone rings all day, every day, as much as it did last year. So my job is harder this year than it was last year because my phone rings as much, but more of those people don't qualify or don't qualify for what they want. So plenty of willing demand. Able demand is harder because affordability is down. Affordability, we talk a million times. 3 things there: home prices, interest rates, incomes. Incomes are not going up fast enough to keep pace with how much home prices already went up and how much interest rates have gone up. Right. So in terms of looking at that, we know we have a decrease in demand because we don't have as much able demand. Well, we also have an equal drop in supply because the sellers are not generally going to sell and get out of the market. They're going to sell and do something else in the market, and they are subject to the same forces that are decreasing the demand. So when you look, Jeb, we saw last week the seasonally adjusted pace for what we're in August, so the July figures, 4.8 million sales over the year, and that's low. That's low. Last year we did what, 6 million? So it's a 20% downturn. So you look at it, and the media again loves to scare you guys, and they go, "Oh my God, we have a housing recession." You're like, I don't even know what that means. I've never heard this used before, other than people are interested in housing and they're afraid of a recession. Let's combine these two things and throw it out there. If we mean, are there less transactions? There absolutely are, and there are some obvious and good reasons for that. But for price changes to come, you have to have a change in the supply-demand balance where supply increases above demand, and we haven't. They've both decreased, and that's kind of what we're seeing. So Jeb, from your perspective, everything you're reading, what you're seeing in the market, is it really just buyer or the sellers? We saw that big run up in the spring and early summer of more sellers. I think there were people that were like, no, I have to sell, and this is my last window, so they came rushing in. And there were some people who were like, well, if I can get my price, I'll sell, and they're lingering or pulling their homes off the market. Right now we've flushed out the people who had a strong desire to sell.
Yeah, no, I'm with you. I mean, I've said a couple of times, I think some of the homes that are on the market that are sitting are sellers just seeing if they can get their price, right? I mean, they may be real sellers if their price comes in, but they're there just testing the market. And those homes are going to continue to come off the market as we head into this, quote unquote fall winter market. Now, some markets, Southern California is a little bit neutral to the fall winter. I mean, we still have seasonality here in Southern California, but not like a market like Wisconsin and some of these that get feet, 12 feet, 15, whatever the number is of snow, where literally you can't leave your house. Those markets are going to be more subject to seasonality than any others, and that is going to start to play a part as we move into coming months, which is part of the reason that I said I think inventory has probably peaked for the years, because every week we follow it here, every week I mention it. And when I start to see a trend, okay, instead of going up every week, now we're staying the same, and now we're starting to decline. That to me is foresight into what's happening, not necessarily in every market, but for the better part of populous markets and what have you. That's probably where we're headed is. And now that doesn't mean that that homes aren't gonna decline, aren't gonna go up. It doesn't mean that more inventory can't come to a market, new homes not gonna pop up tomorrow. It doesn't mean that at all. It just means that there's less inventory out there, there's less demand, and that's the reason that you're seeing these headlines, these housing recession, these Fannie Mae revised their forecast today to whatever it is, whatever crazy number they threw out there, and they're talking about home sales. Okay, wouldn't you expect home sales to go down when we just went from a 3% interest rate to a 6% interest rate, and home prices just went up 20, 40% in a 2-year period? Of course you would, but it's a headline, right? It's out there to grab attention, to get people to look at it. When you don't read the data, you don't go into the detail, it looks scary. But the reality is we're heading back to where we were prior to the pandemic. Now we're actually going to have less sales than we did prior to the pandemic, because it's affordability is an issue now, Josh. And so the question becomes, it's you and I have a bit of a difference in opinion with regards to what home prices can do over the next 12 months, 18 months or so. I see more of a sideways, maybe even slightly down movement in some of these markets. And now when I say down, I'm talking, 3, maybe 5% in some of these markets, worst case. Whereas you see maybe 3%, 5% on the upside. And the reason I say what I say is because, I look at some of the homes that have sold in communities. For example, I have a property that's in escrow now. It's in escrow at 1.5. Okay, 1.5 million. Set on the market for 88 days. Sold for 1.5, which was $25,000 above the asking price of 1.475. Now, keep in mind, we originally listed that property at 1.6 million. Why? The sellers thought it was worth 1.6 million. Why did they think that? Well, there was a property that came on the market in the spring that sold for $1,555,000. They said, my home's nicer than that home. My home's in a better location. My home has an ocean view. Therefore, I think this price is justified. Okay. We talked about the market slowing a little bit. We talked about some difference in, how that market differed from the market that we were in now. Hey, let's test it out. Let's see what happens. I've been wrong before. I was wrong several times during the pandemic where people got way more money than they thought they would. And so what happened is we set on the market. We adjusted our price downward to probably closer to where we should have been to start with, because that one sale was, to me, the black swan, if you will. When you look at data, sometimes you extrapolate the high and the low, right? Because they're just off events. In this case, that high at $1,555,000 was one that should probably have just taken out and not used based on where property values are. But here's the thing. People are going to use that number when they say prices have declined from whatever number. So when I talk about prices moving downwards, I'm not necessarily saying I think the market as a whole does it, but I do think there are, some properties in communities that are going to sell for less than a home that sold, maybe very similar condition than a home that sold in the spring, just because of the craziness that happened during the spring. Those sales, in my opinion, probably shouldn't have happened at those prices, but they did. Does that make sense, Josh?
No, it does. And a couple of things, just starting with that. An interesting thing about houses is they're not like cars. If you want a black Camaro, there's probably 80 of them on dealerships around the country. So what they sell for, I mean, there's variances, regional, people in the South probably like those Camaros more than people here in Southern California, but
Why you
they're
say that, bro?
equal. They're equal. Each one is the same. Homes are always a little bit different, and it's hard to say. You and I had a discussion before. Why did that house sell across the street for a little bit more? Had someone than it should have? Had someone been beaten out 5 times, and like this was the one, and they just weren't willing to get beaten out, so it went 50 grand higher. So the next one probably isn't going to have someone that motivated. Was it next door to the in-laws, and the wife was saying, "We are going to live next door to my parents. I don't care what it takes." We don't know the reason. So when you say that you and I disagree, we absolutely do in terms of our market, Southern California, California in general, the populous parts, the coastal parts of California. So Bay Area, Southern California, I do not see a downturn in home prices in the next 12 months. But let's kind of step back and say, interesting time of year. For those of you that play fantasy football, anyone is getting ready for their drafts. And a concept that you have to think is we all sit here and project what X, Y, and Z player are going to do over this year. None of us know. So if that person stays healthy, you say, what is the potential range of outcomes? So this is kind of helpful. That concept is helpful when you're making decisions with housing this year, because there is uncertainty. It has changed. It is different. We have a decrease in demand. We have a decrease in supply. What does that mean? We don't know what's going to happen with interest rates going forward. I have a high expectation that whether it's later or sooner, we're going to get a return to lower interest rates, which will be supportive of prices. It won't shoot things off again. But in that range of potential outcomes for the California market, could we see a 10% downturn? Yeah, that's probably the low end or the high end of a downturn in terms of that range of outcomes. On the high end, could we see appreciation more than 5%? Absent rates dropping considerably, like back to under 4%? I don't think so. So the likely outcome is, again, sellers post up and say, I've got a great rate. I've got a home that's worked for me for the last 10 years. I'm not going to move. So we have limitations of supply. Those people are all sitting on great interest rates, lots of equity, and absent something unforeseen, a divorce, a job transfer, they're not likely to move. So I foresee lower sales volume, stable prices, not necessarily increasing much. But again, you have to tell me why someone is going to say, wait, my neighbor sold at $1,550,000 or $750,000, and I'm going to take $700,000. I got to be a really motivated seller to do that, or just a logical person that can say, well, I mean, that house was rad, totally fixed up and had a bitchin' pool, and so yeah, they got more than me. As we know, most sellers are not rational, and I don't mean just home sellers. Anyone, again, going back to fantasy football, try to trade with someone. any guy they have is the greatest guy ever. Well, once you have it at your house is the greatest house ever. It doesn't matter who you are. That's sort of what you're dealing with. So most people will say, I'm not going to make a trade because I like what I have more than what my alternatives are. So I definitely think the lower volume is here with us for the foreseeable future, and lower rates of appreciation than what we've seen over time. Jeb, were you tired of
Yep,
us
I'm
seeing your
out, bro.
face?
I said, screw this. I was tired of listening to you
But
talk.
I don't want to hear him jibber jabber
We're
anymore.
really
And
having a strong performance tonight,
what did you do
everyone.
technically? Did you change your setup over there?
Yeah, I just said, screw this. I'm out, man. I figured I would do the show. I had that Graham guy in the comments talking crap about me, so I got really timid and scared and decided to leave. I just said, the hell with this. Like, nobody appreciates me, man. So I left.
Graham's
I'm
pissed
coming
because
back. Am I coming back?
he has 23
Am I
subscribers on
coming
YouTube.
back? Oh, I'm coming back. Yep. Now I'm going back out. Here I come. Holy cow. Tonight is awesome, guys. We're really running I think would be our first time doing this, but it's not. This is like number 50 or something crazy. Actually more than that, I think. So anyhow, no, I agree with you, man. I think the thing that you said is that it's very important, and we've talked about it 100 times, and I'm not going to dive into detail here, is the fact that people have low rates locked in. It's significantly more expensive to move. There's transaction cost with selling a home. There's transaction cost with buying a home. There's a lot in there. And the reality is the people that are upset are the people that are priced out of the market, the people that didn't get in, the people that don't think they have a chance. And that's, and I get it. Like, I understand the frustration and the hopeful thought and the wanting and all of that. I get it. I get it all. It makes perfect sense to me, but it's emotional and it doesn't get you a house. And that's the reality. And so, yeah. And so we're here to provide you information. You can like me, you can dislike me. It's okay. I'm okay with it. And so with that, Jennifer, you can actually leave those comments. You don't have to delete anything out of there. I'm okay with it unless it's completely vulgar. Just leave it. It's good.
No,
it's all good.
the thing to say, again, we're not going to give someone, that just comes here to troll too much, but it is sitting here saying, just a real estate cheerleader hasn't done the research. Well, you're ignorant because you have no idea the volume of research that Jeb does, that I do, the things we pass back and forth. I don't know that anyone in the country does more, other than maybe someone like an Ed Pinto at the American Enterprise Institute, that is his job. He doesn't have to actually do anything other than do research. So if you want to have a conversation, jump on the phone. I'd love to have it, because I don't know what research you imagine you've done, but I know it's 1/10 of what either of us do. So again, if you don't like it, go watch Reventure Consulting, dream about a giant monster crash that has not and will not come. But to say someone hasn't done research when I have all the research and all the data to refute anything that you have to say, that doesn't mean that we have a crystal ball and I can tell you what's going to come next. But to say that they haven't done the research and we're just cheerleading, that's silly. You're silly.
Dude, you gave that way more time than I wanted to give it.
Yeah.
So with that, we're going to move on. But let's talk about something really positive here, Josh. We got $10,000 in free student loans being forgiven. I would love to know what you guys think about that. Let's talk about that on top of housing. I think it's great.
Well,
I mean, inflation is no problem at the moment. Let's give out some free money.
Let's stimulate.
Good stuff.
Yeah, we passed the Inflation Reduction Act, and now we're going to give some more money.
And now we're just going to add to it.
Inflation.
All right, so big news. Let's talk about this, and then we'll start talking about some questions. Big news this week is the fact that the Fed, not the Fed, Jerome Powell, Jackson Hole, this Friday is going to give his thoughts on the future of interest rate hikes for the most part, right? There's some people in the Fed that thinks they need to get way more aggressive on hikes. And then there's members of the Fed that thinks or that think that they should be done with hikes. Josh and I were talking earlier this week, and one thing Josh mentioned that I think is important here is that Jerome Powell is pretty even kill with regards to, his remarks and how he conveys his thoughts. He's not really an emotional, speaker, if you will. He's going to be pretty monotone with what he has to say. And my guess is they're going to continue kind of sticking to their plan for the most part, but might just add some additional language about monitoring what's out there. And because of all this, uncertainty, if you will, it creates volatility in the market. I mean, we've seen interest rates this week jump up quite a bit. But one thing I want to point out on that, Josh, and I think is important here is, somebody commented on my channel earlier today and said, hey, listen, interest rates today are at, back up to 6%. Maybe for some people, you can't, just go look at sites like Mortgage News Daily, while they're great sites and provide a lot of useful information, and take, where their 30-year fixed rate is on that website at face value and say that's what it is across the board. Because I have a client right now, again, looking for a property, well qualified, 20% down. He's been talking to Josh and talking to other lenders as well. And he's getting quoted between 5.75 and like 5.25% today. And so that's significantly lower than what, these websites are showing out there. That's why it's important to talk to a professional, talk to an expert, and have those conversations versus just reading, what's online there. Anything you want to add on inflation rates there, Josh, before we dive into some questions?
No, here's the important thing. There was a comment, and we don't need to post it or throw it up here, but someone said, the Fed's going to 5% and higher. This is the end of the road. Same. Again, if you don't understand the way the markets work and what the Fed can and can't do, don't read the scary headlines and then spout that as something that's going to happen. The Fed could do that. They might, but they don't directly control the markets. So if the Fed funds, what do we have, 3.75 somewhere and heading towards 4.5 here. So yep. We're not even far from 5. Look at the 10-year Treasury. This is what I always say. Look at the 10-year. Look at the 30-year. The 10-year Treasury, people are lining up every day to loan the U.S. government over the last month, 10 years for 2.75 to 3.25% interest. So that's with the government saying inflation is 8.9%. Do these people say, hey, I'm cool with losing 6% of my purchasing power on my money for the next 10 years to make the government this nice loan? No, these are real money managers out there buying assets and making investments. They're telling you that inflation is not going to be a problem 1, 2, 3 years down the line. The Fed has to do what they have to do, but we've talked about this before. If you saw your neighbor come flying into your neighborhood at 100 miles an hour, and then he just stomped on the brakes, you wouldn't go, oh yeah, he absolutely had to stomp on the brakes. You'd say that idiot shouldn't have been going 100 miles an hour in my neighborhood. Well, for the last year, all of 2021, the Fed is continuing to stimulate when the economy is doing incredibly well, even into the first quarter of this year. They wouldn't have to jump on the brakes as hard as they are if they hadn't done the things they did, stimulating far too long into the recovery. And we still have our government, the party in power, 50-50 split in the Senate, but we're going to override it with a vice president vote, spending another $1 trillion. Keep spending money and watch what happens with inflation. So again, now we're gonna qualify. We're gonna cancel student loan debt. We could have probably just a show just on student loan debt. I know more about. I played college basketball on a scholarship. I never took out a student loan. So I would have thought I would be the dumbest, most ignorant person in relation to student loans that there is. I know a ton about student loans because 50-60% of my clients have them. But when we're sitting here saying, hey, government's just going to wave a magic wand and make this go away, there are absolutely situations where there were predatory loans out there, people that probably deserve forgiveness. But again, that's just a screw up by our government. Again, creating another program where we don't have safeguards in place. If you look back, Jeb, to 2008, what did we have by 2010? We had a bunch of rules that prevented the crazy loans that were put in place. We've been watching this train wreck in student loans going for about that long, 15 years. And yet graduate students can borrow money with no limit. If you're in college getting the craziest degree you've ever seen, you can borrow as much as you want, including all of your living expenses. I regularly see clients with $300,000 and $400,000 of student loans. Now, was that predatory when you were signing saying, please give me more money for this worthless degree? And should all taxpayers be required to offset that? But in the context of this conversation, what we're talking about is it's government spending that leads things higher. But any way you cut it, the future is disinflationary from today. Is that 1 year from today, 3 years from today? We're going to have a slower housing market. There's going to be less transactions. We shouldn't expect a bunch of appreciation going forward, and there will be better interest rates ahead that will be somewhat supportive, but not taking things back to the way that they were.
Agreed. Yeah. And somebody asked about the student loan, if there's a catch, a caveat, a contingency with it. I believe that it has to be filed on your tax returns, a portion of it at least. Again, I don't know the details of that. That's the last time they did it. What this plan, if you will, does, I'm not 100% sure. So I'm sure there's YouTube videos all over it at the moment talking about this thing because it's a hot topic and it's trending and all that good stuff. So you can go out there and get it, but unfortunately I don't have it. So here's where we actually start answering your questions. The reason that you guys are here, I see a lot of familiar names in the chat. So thank you guys for showing up weekly. Some of you have been here ever since you've purchased homes. I mean, you purchased last year, you're still here. Thank you. Thank you to Jennifer for showing up again and moderating the chat. It's much appreciated. So we got people from Pennsylvania. Let's see here. What do we got? That's it. Pennsylvania, Massachusetts, California, a lot of California. So thank you guys. So Emilio, I'm sure Emilio says, where do you see the market in the beginning of 2023? So beginning of the year is typically the slowest time for any market, just because you're coming out of the holidays. Usually that time of year, we're at our lowest level of inventory that we'll see for that year. And it's also, you're coming out of, this, the holidays, if you will, kind of that, that time where you've been with family and just like, buying a house probably isn't at the top of your priority list on top of you're getting ready to file taxes. So there's a lot going on there. So I expect the beginning of the year probably to be one of the slower points in the year. What does that mean exactly? Probably just less transactions happening. A lot of it has to do with interest rates. I mean, where are interest rates in January? Hard to say at this point. If I had to guess, I would probably say we're probably somewhere in that, 4.5% to 5.5% range would be my guess. And that is really what it is a guess. But it's going to have a lot to do with that. If you see, rates come back down, it might, push, some buyer demand back out there. But the reality is, affordability is not going to correct itself in the next 6 months. So it's just going to be, I expect 2023 as a whole to be a slower market than 2022. So year over year, you're going to have some, especially for the first 3 or 4 months of the year, because we had such high numbers of transactions done during those times. The year over year numbers are going to look pretty bad, right? With decline in the number of sales, just a lot of things that happened in the first quarter of this year that probably aren't going to happen in the first quarter of next year. So the numbers are going to look dismal, but it's not, that doesn't necessarily mean the market's collapsing. It's just how they evaluate those numbers. So Josh, what are your thoughts on 2023?
I would say the same thing. It's going to look a lot like the second half of this year. What's going to change? Our income's going to shoot up next year? Unlikely. Talked about, home prices could drop, but let's say if they did, that doesn't help affordability where people go, hey, let me go buy a house. They go, oh my God, I got to stay the hell away because home prices are dropping. That's what happens. We get people in the comment section all the time saying, hey, I'm just waiting for this big correction. I'm going to jump back in. Those people don't jump back in. They get scared and they go, I'm not trying to catch a falling knife. I'm going to wait till it goes down and stops going down. So I don't expect that to happen. The only thing that could move in the favor of housing would be lower interest rates. And there's a likelihood that we get that. But are they going to be appreciably lower? Does a 4.5% conventional rate make a huge difference over where we're at? We saw a few weeks ago, rates peaked at like 5.875. At one point, we got down to good borrower paying a half point, 1 point would have got 4.875, 4.99. It wasn't a rush of people coming back in to buy. There's some seasonality to that. But the answer to the question of next year, it looks a lot like the second half of this year with slightly better interest rates, but it won't change much of anything.
No, agreed. So let's move on here. You got Esther saying she loves this podcast. She showed up earlier. And I think she's a realtor, so she gets a lot of information from here. So thanks for watching. Lorena also saying thank you for the knowledge and the time. The reason I'm putting these up here is because we had some shitty comments earlier, and I like these better than those. So I'm gonna put these up there instead of the crappy ones. Let's see what we got here. Dixieland Production. Question. Jeb, you hit 60,000 plus. You said you were going to retire when you hit 60,000. Did you change your mind? P.S. Congratulations. Thank you for that. Appreciate the support here, guys. It was more of a joke than anything else. You know what? I think, I enjoyed the talking to you guys in this regard. I enjoyed the education aspect of YouTube and getting the notes of the people that actually were able to use something that, I talked about, that we talked about, and made a purchase, and it made an impact in your life. That stuff's great. What gets bored and, just repetitive is the constant talking about the same thing over and over again. And that part is obviously, not frustrating. It's not fun. So what I decided was I'll stay here and help educate and guide people through the market until we start to see a really good market again, at which point maybe the haters are gone at that point on YouTube. I've done my part, and I can stop doing this. How's that? That might be 5 years from now. I don't know. But I'd be interested to know what you guys want to hear more of, because you got to get bored of me talking about the same things over and over.
No, Jeb, we talk about this. There are some hardcores out there of you that have been watching for a year, 2 years, people that are in the industry and like to hear this stuff. But for the most part, the reason why you don't see one with a real estate or a mortgage channel that has 500,000 subscribers is people are hyper interested for a short period of time. Then they get their mortgage or they buy their house and they're less interested. They're never just disinterested. Once you own a house, you want to keep up on housing news, but you're not going to tune into stuff like this once you've made the big decision and put it behind you. So what we get is a constant cycle every 3 to 6 months of a new batch of people who are considering this, and they have the same questions as the last batch of people. So it does, at a certain point, there's always changes. There's always new things. Currently, the market is very different than it was 6 months ago, which is different than it was 12 months before that. So there's changes, but from a week-to-week basis, it's a lot of the same questions, but it's still really important. I feel that home ownership and doing it smart, buying wise, borrowing smart, building wealth through real estate is really important. You owe it to yourself to educate yourself, and if that means we answer the same questions repeatedly, then that's what it takes. And a lot of times it's asked in a slightly different way or with a unique twist. So we get to learn things. Sometimes I get asked questions on here or other places. I go, that's interesting. I should go down that rabbit hole and research it a little bit more. So we learn in addition to giving you guys information.
No, and honestly, I talk about this. I did a video today. It's going to be out probably Monday. And basically I talk about my mistakes in the real estate market, what I did, where I bought houses wrong, the mistakes I've made, the regrets, quote unquote, not really regrets, just what I've learned. And I think that's important. And that's a big reason that I think the channel is here to begin with, because there's so much misinformation out there. And just, I worked in a broker shop before I did mortgages. I was kind of in a small broker shop where I saw a lot of crappy things happen. A lot of people get overcharged, a lot of people not educated on what they were getting and how they were getting it. And that basically got us to now. That's why I talk so much about this stuff, is because there's really a lack of information. And I'll tell you, half the people that you're talking to on the mortgage side don't understand even what they're selling. They don't understand the ins and outs of the products. They don't understand the pros and cons. They just don't. And so be it, whatever. But that's the reason that we do this sort of thing. I do this thing is to give that education, because I think it's important. It's this is a huge decision that you're making, and I've made crappy ones, right? And so I think if I can pass along what I've learned to other people, that is why we're here. So anyhow, Matt's got a good question here. So Matt, the mortgage guy, is not Rihanna Keeves. He is Matt, the mortgage guy. So Matt is here on YouTube as well. I'm sure a lot of you guys have seen his channel. Talks about mortgages. Thank you, Matt, for being here. Says, let's hear about the conversations you're having with agents when thinking about offering on a house with no offers. How are you leveraging the market to get buyers the best deal? So it's a really interesting question, because, the offers that I've put in recently, have all been multiple offer situations. Some of the homes have been on the market for, a period of time. Some of the homes just came on the market. And so every single one of these has been a multiple offer situation. So there's very little leverage. In fact, we haven't won them. And you could say, well, they're just saying it's a multiple offer situation and trying to get you up in price and whatever. No, we've gone up in price and still haven't gotten the deal. So that's how I know that, yeah, what they were saying was accurate, because we haven't been winners in these situations. So, the ones that have been sitting on the market a little bit longer, you're obviously, as a real estate agent, I would say that this market would be no different than a market in 2019, prior to the pandemic. And it's looking at the comparables and helping make sense of what those comparables are, right? So if they're using a comparable from February to justify their price, it's hard to say that February was like now, because rates were much lower when that went into escrow. And so I think it's all about having that conversation. Now, understand, a lot of times agents get in the way. They get in the way of transactions because, they start negotiating on behalf of their seller without the seller actually being involved. And that's a problem in real estate to begin with. So, you try to have conversations with people, reasonable conversations, and find out why they're coming around with the price that they're coming out. Like, how are they getting to that price? And sometimes their argument makes sense, something that I wasn't accounting, and sometimes it doesn't make sense. So I don't know that there's a surefire way to get it done. But I would tell you, unless you're significantly off on value, submit an offer and just see where it goes, right? If you have an offer, they should be presenting it. Having a conversation, they may or may not, convey that conversation to the seller. Whereas you put something in writing, they have to present it. Now, if you're one of those buyers out there looking for something that's, $150,000 below the asking price on a property that's listed at, 1.3 or whatever, that you're probably not going to get anywhere with that sort of thing. But each case is a little bit different. I don't know that there's a right or, no steadfast language that you're using in every transaction to get things happen. And all markets are different, as you know, Matt. All right, Josh, let's see here. What do we got? We got any good questions for you, my friend? No mortgage questions really, huh?
Well, here, let's follow up. Matt, again, this is an interesting take on it. Sacramento, a little bit different. And Sacramento was hot. Was hot. I help a lot of clients in the Sacramento area because it's affordable. A lot of first-time buyers that come from the internet, that find our website, that find us through Jeb. We did a lot of business there, and they were having a heck of a time getting homes under the market. So he says, interesting, we've got a decent amount of inventory in Sacramento. There's 30-plus days on the market with no offers. I think a great buy-side agent needs to coach up the list side to present to the seller. I don't know, Jeb, like when I hear this, I go back to how serious are these sellers? Do they really, really want to sell? Now, if they're selling to entry-level buyers, in Sacramento, that's probably what, 350 to 450, the people that would be leaving and wanting to move up. Yeah, they probably want to move up. But when they're looking at the numbers and they go, okay, so I'm going to leave my $400,000 house. I need to get to 550 or 6. I'm leaving my 275 rate. I'm going to 5.5. I don't like that. I don't like that a lot. I'm leaving my Prop 13 lower tax rate. That house that I'm selling for 4, I probably bought for 225. So I'm tripling my taxes on it at the same time. Definitely, there's a skilled buyer's agent who could present the information to sellers and help them understand. There's some strategies around buy downs that can be helpful, but again, to a degree, the seller paid buy downs, 2-1 buy down, 3-2 or 3-2-1, 1-0 buy downs. They're just kind of moving the peanut around. You have to have a strategy with it and use them strategically. So we can help a little bit on the lending side with that, both helping buyers understand. It just comes down to if that's a market that slowed down, and it's good to have that information because, like I said, Jeb and I primarily, I would say 65% of my business is Southern California. We're not seeing that. I don't see properties that are sitting. They may need a price reduction, but they'll get an offer when they get it correct.
No. So here's the thing. I think there's some confusion in what days on the market actually means to some extent, right? Not what it means, but seeing a house that's on the market for 30 days, for example, right? Whereas they were selling it 10 days or 12 days. To me, that's not I don't get shocked by that, because that's a normal market, right? I mean, go back to 2019. What was the average days on market in 2019? It was probably 60, 70 days, right? I mean, maybe even more. I don't remember exactly at that time. I could go figure it out. So when I see a property sit on the market in the middle of summer in a market that is slowing, I'm not really that concerned. Now, again, if the seller's not willing to do anything and they're stuck on a price that I think is too high and we're not getting any showings at all, then yeah, it's a little bit concerning. And some of those cases that's exactly what it's going to be. But I think, here in Orange County, our average days on market 2 weeks ago or 4 weeks ago was like 72 days. Last 2 weeks ago, it moved down to like 64 days. Today, I think it sits at like 64 days. So we went from higher days on the market. We went from really low to, upwards, and we kind of reached this 70s number. Now we're back down again. Why? Because we got a little bit more demand. Things are, kind of moving along again because rates came down a little bit. But, seller, once, in a market like 2008, dude, we had homes sitting on the market for 300 days. Like, some of these things, a year and a half. I mean, I know agents that wouldn't take a listing contract for anything less than 18 months because you didn't know if it was going to sell because there was so much inventory. So we're not there, but it's a slowing market. Things are going to sit a little bit longer. So
in 2010, Jeb, in Southern California, we got up around 500 days on market on average. So in context, 60 is still low. It's not ultra low. It's not scare you low that there's 80 offers on every property, but it's still low.
No,
We're moving in the right direction. Jeb, at risk of giving Matt the floor for all
no, I was actually going to address this. Yeah.
Okay.
So Matt, So Matt, you asked this question, portion of inventory is also open door, blah, blah, blah. Here's the thing. A client of mine called yesterday, showed me a property, said, "Hey, what's the deal with this particular property?" And it was an open door property. And she said, "Hey, look, they bought it 2 months ago or a month ago, and they're selling it for $200,000 less. What's going on?" Type in the address, doesn't come up in the active listing. The new listing comes up in the MLS, but when they sold it off market. So what happened was a seller sold this property to Open Door. It closed in June. It closed in June for like $1,250,000-ish. Let's just call it that, $1,225,000, somewhere in that ballpark. They have it listed today at $1,025,000 or something. So $200,000 less than they paid for it 2 months ago. So I asked Josh, Josh, in what world would they sell this property for $200,000 less and they bought it 2 months ago? And I go look up the comps in the area. The comps support somewhere between $1,250,000 and $1,300,000 of properties that have just closed. So recent comps, not comps that closed 6 months ago. So I'm trying to figure out in my head why they come on the market $200,000 less just 2 months ago. Now, I'll tell you, if somebody sees that online, they immediately say, uh-oh, that's it. Homes are crashing. I see that and go, they're trying to price it low enough to drive up demand and get some attention on this property to get people in the door. That's what they're doing. Now, what ends up happening? I don't know. I mean, I've tried to call the agent on this, but the way they do their stuff, you call the agent, it's an 800 number. It's very difficult to get any information. But my guess is they're pricing it low to get offers and bid the price up. But we'll come back to you with the end result on this. When there's actually something to report.
It's still interesting, Jeb. I had to look up a property that a client is buying today on Redfin to get some information. And for some reason, it thought I wanted to sell my house and move to 29 Palms. So it asked if I wanted a cash offer.
Ooh,
and I'm like, these
yes.
companies are still out here making cash offers when they've proven to be absolute morons. Like, imagine every house flipper I know has done great the last 2 years because you couldn't not do great. We watched Graham Stephan interviewed the buddy of his that flips in Vegas on a big scale, and he said literally the last 100 houses they've done sold for 15 to 20% more than their aggressive projection when they bought. So it's hard to lose money. Zillow lost a shit ton of money. Like, it tells you, like, corporations, You think they have access to money, low cost of funds, that we were talking about the economies of scale of building out contracting crews and keeping them working. We've told the story here on the show. 2 houses sold in my neighborhood last year. One had a really bitchin' lot in a better location. Like from my house, one is 100 yards this way, one is 100 yards that way. And they weren't identical homes. But one ended up selling for way less than it should have. And it took between Open Door buying it, holding it, closing escrow on it, took like 9 months. The other one down at the other end of the house sold at an extremely exorbitant price with a good agent listing it. It is a bitchin' lot, terrible house, bitchin' lot. The people that are buying it haven't even moved in a year later because they're doing plans to take advantage of the lot. But long way of saying, Open Door like totally underperformed. They overpaid too much when they bought it, and they didn't get enough when they sold it. And they're doing this on scale, at scale, and we're going into a much different market. So whole different thing with the iBuyers and what they think they're doing. They don't seem to know much of anything. They have access to hedge fund money, and they're throwing it around and making a mess.
Good stuff. So Vincat, I went under home contract 3 months ago. 3 months back and paid $40,000 as earnest money. Now I want to get out the deal. Is there any way I can get my $40K back? I bought the house in Raleigh. So I'm not sure what Raleigh looks like. Here's what I do know about North Carolina. There's typically 2 deposits. One that is based on contingencies, and then there's one that's non-refundable, right? You're giving that money up, once the seller accepts your offer. And so I don't know if new construction in the state of North Carolina works the same way, if there's an opportunity for you to get that money back. What I would recommend is if you have an agent that helped you represent that transaction, go to them and have that conversation and tell them where you are. And then your other option is to go to the builder and tell them exactly where you're at and see if there's anything they are willing to do. Some builders out there are offering incentives now. So maybe even if they don't let you out, maybe they offer you some sort of incentive to stay in the contract. Maybe they don't. I don't know. But you got to have that conversation, right? I think, again, talk to your agent, talk to the builder. That's where you need to start and see if there's any options to get it back. But I do know a lot of builders, when you back out of contracts, that money is non-refundable. So I hope that you get better news. Steve says, what are the main reasons sellers in Huntington Beach are putting their homes on the market? So in my market, I'll tell you so I have one on the market at the moment. Got stuffy all of a sudden. Those sellers, he is nearing the end of retirement. This was kind of a quasi second home, although he lived here a good portion of the time. He's getting ready to retire. And so they have another house up actually in the Sacramento area, and they're selling this and they're going to move up there to be there full time. What else do I have? I've got my neighbor. My neighbor is selling her house. Well, she's basically has like Parkinson's, MS, something going on in there. They recently put her in a home. Kids are basically selling the house. So that house, that's a reason that people are selling. I just did 2 listing appointments recently here in Huntington Beach. Both of those were trust sales. Someone passed away, left the family, left the property in a trust to the heirs. The heirs are selling those properties. So those are some of the reasons that people sell. Me, for example, I just kind of went through this scenario. I put an offer in on one of my neighbor's houses that was off market, verbal offer in last week. Got back to me earlier, yesterday, and basically said that he's decided that he's just going to keep the property, doesn't want to sell it yet. So if I were to, I was kind of in this quasi, position. Do I keep my property and rent it out, or do I sell my property because I have a lot of equity in it, take that capital gains exemption, not lock it up as an investment property, never, and have to 1031 it in the future or what have you, and go buy other investment properties. So I would have potentially been a seller because I was buying another property. So I think those are really the reasons, right? Somebody's selling a house to buy another, someone passed away, somebody's moving. Those are really the reasons that people sell. I mean, outside of that, I don't know why one would sell a property.
I got the story, Jeb, on the folks that bitchin' house around the corner from me. These folks bought 7 or 8 years ago, did a nice exterior
is that the one
remodel.
with the yellow door?
Yep.
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 Okay.
Sister is in town helping her sister pack up, and said, "Yeah, they're moving to Texas." And then my wife sees the wife a couple days later, who's usually very friendly, and was a little bit short, and it seemed just kind of weird. So either family problems, or the stated reason is got a job move to Texas. So
Yeah. And it could be
same
divorce.
stuff.
It could be a lot of stuff. I mean, you just don't know what people go through and why people sell. But what I will say is I don't have any people personally that are panicking about the market. And, hey, I'm selling because I'm getting out. So I don't know I mean, that's a reason probably for some people, but I haven't come across those. At the same time, I have people buying too. So it's not all, just people looking to get out. Clearly there's a buyer on the other side of that.
And from that end, you talk about any distress. The only distressed client that I've talked to, I got a call about 2 weeks ago, have a borrower who 2 years ago, it was 3, 4 years ago, we did his purchase. We did the refi when the rates dropped. And I'm wondering why he's calling. Well, he needs to cash out and he needs it urgently, because I said, hey, rates are a lot higher than the loan that we did for you. He says, well, I quit my job. I started a business and I had a vendor just steal $75,000 from me, and I have to deliver products real quick, and I need what that vendor was supposed to give to us. So does distress happen? It happens all day, every day, but nothing that I'm hearing or seeing or talking to clients that's popping up where they're saying, hey, I'm in trouble, I can't make my payments, need forbearance, what are my options, can I get help?
No, good stuff. Vincat came back and said, as a buyer, if I back out of the deal before closing, can the builder come back at me or sue me? So typically, if you decide to back out of one of these contracts, there's no recourse for them coming back to get you. You basically just lose your good faith deposit. That's how it works here in California. Once you've released your contingencies, that's what's at risk there. Is that deposit. So I would imagine North Carolina probably operates in a similar fashion, but again, talk to somebody there. They'll know more. And quite frankly, your contract, that 500-page contract you signed for a new construction, will probably have something in there. Exaggerating a little bit, but yeah. Let's see. Alberto says, I bought my house in March at top dollar with the goal of keeping the house for 5 years. Do you think 5 years is a good time horizon for the house recover from the recent price drop? So I think if you bought in March, unless you significantly overpaid for that house, you're probably sitting somewhere around the same value. I can't imagine, unless you're in, I don't know what market you're in, but I'd be interested to find out. I don't think that there's many price declines out there that are significant at the moment. But I think having that longer term time horizon allows property values to come back if they do end up declining. Hard to say what happens in 5 years. I like that 5, 7, 10 year time horizon. So I think if you're buying now, having that time horizon allows you to withstand those bumps in the road. So I think you did the right thing, but hard to say what it looks like in 5 years.
And again, so we just heard a second ago, homes in Sacramento coming on the market, not getting offers. So those people price them at that level, other than the open doors and other iBuyers, thinking that's a reasonable price. So there may be some areas that have seen price declines. Southern California, Bay Area. I saw Black Knight released a number that said Bay Area home prices are down 10%. And I'm like, I don't know. We get a lot of inquiries from the Bay Area, people fleeing because of the home prices, not excited because they dropped 10% here. So haven't seen it yet. Doesn't mean it's not going to happen. Like we said, it is within the realm of possibility of the potential range of outcomes. If something like that happens, we want to look to the past. We had a little downturn when we had the S&L crisis in the late 80s. For us in Southern California, which is a more cyclical market than most of the markets around the country, lost about 10 to 12% of value, and it took about 3 to 4 years to get back above. So if you're a buyer putting minimum down, it's something to be aware of and to be cognizant of, and have a longer time horizon. Just like 5 years is probably the minimum that you would want to have if you're buying with a minimum down right now. Jeb, one of the things that, what were you say?
I was going to say, even if you take the biggest, quote unquote crash in history, talking about, and it's not really a quote unquote, it is really the biggest crash in history in 2008. And you looked at, the peak in home prices then, how long did it take them to get back to those prices? Many markets, it was less than 10 years, 10 years being on the high side. Some markets were, 5 to 6, some were 7 or 8, right? So, but it was 10 years. So, and that was the biggest financial crisis ever. So many different, things affected, not just the US, but globally, and still home prices were able to make it back in 10 years. So that's why we talk about that time horizon, because it's important, in holding any asset, not just real estate, stocks, anything, right? Long term, if you have time on your side, you're going to be sitting, in good shape. Josh, what were we saying?
I lost my train of thought.
It's
You,
all right.
you totally
I'm going
disrupted
to
me.
be here
Let's
when it comes back.
let's jump in here. There's some good
Yep.
news and some interesting news and some news that kind of gives context on an anecdotal basis for some of the home builder information we've seen here.
Yep.
So just Will, for him, this is fantastic news. Price listed at 445, cut to 399. He got it at 390 and got 12 grand to buy that rate down to 3.87%.
Awesome.
He got a time machine back to early spring interest rates and got a 10% plus cut in home prices. That goes a long ways towards protecting you. So we get the question every week, what do I do asking for concessions? What do I do with my offer? Do I shoot my shot? Always shoot your shot. Will did that and got a great deal here. One of the things when I'm seeing the home builder figures come out, I'm tempted to say home builders are big corporations. They're pretty smart. But if we look back to 2007, 2008, they were not smart. They were building at peak high volume right into the crash. We've talked before about there's a concept of we're always fighting the last war. Builders still remember that painfully what happened to them 15 years ago, and they don't want to repeat that. So we don't have a ton of homes coming to the market. What was the number, Jeb? 24% of the homes, the new construction available for sale, is actually been built and available to be sold, and 76% is in some stage of construction.
I don't remember exactly, but that sounds about right. Yeah.
It's about right. It's somewhere in that 20% range. So granted, these are large corporations. They don't have the option of not building. They have to make money. And if they don't sell houses, they don't make any money. So they're rational and they know what their margins are and they know what their carrying costs are and they know when this makes sense. This isn't a panicked seller. This isn't the guy losing his job and going, hey, I'll sell Will at any price and I'll give him big credit so he can buy his interest rate down. This is a large corporation saying, hey, our margins had gotten pretty nice as home prices had run up, and maybe we take a little haircut on this one and just get it off the books and pay off some of our debt. So
Right.
I think we will see them behave pretty responsibly going forward, and they will slow play building out what they had planned so that they can sustain prices. They know where they need to be on sale prices to make money on the homes. They're not going to sell the loss. They're not going to overbuild and force themselves into a difficult situation, but we are seeing stuff like this.
No, understood. So look at this is the chart you were just asking about. So the red is homes that are completed, the blue are homes that are under construction, and the green are homes that have a permit but aren't built. Now, one thing I was, I think I mentioned this last week. I was talking to two different agents, one in Tampa and one in Dallas. They do a lot of new construction. And I said, what portion of the new construction they're building in these markets is already under contract? And they said, pretty much all of it, right? I mean, these builders, when they go to build homes, they're doing contracts initially before these homes are built. So a good portion of that blue that you see on that chart there, those homes aren't available. They're not going to be available. Now, some people will back out, some people won't qualify, whatever. So some of that will fall out, but those aren't just, homes that are just going to show up and not necessarily have anyone to buy them. Some will, but just, keep that in mind, that again, when you look at the numbers as a whole, it looks like a lot, but it's not really quite, it's a bit deceiving in how those numbers are calculated and what's actually available. But that brings me up to a question I saw earlier, Josh, that I wanted to answer and I completely forgot. And I don't know if Anya's still here. I think it was Anya, where she says, what does inventory look like nationwide? Do you remember that one?
Yeah, it was early. And
It
it was
was
Anya.
early, and I'm trying to find it. I saw it. I'm coming for you. I'm coming for you. Give me a second. Here we go. No, maybe not. Maybe not. Yes. No. Anybody? I can't find it, dude. Anyway, she asked about inventory nationwide. What does it look like? And I think currently, Josh, we sit at like 1.2 million homes available or something crazy. What is it? Does that sound right?
That's a
I don't
figure I haven't looked
remember.
at recently, so I'm
I
going to be
don't
zero
remember.
help to you on that.
I'll find it here in a minute. I'm just guessing off the top of my head, but I think 1.6 ish is like a more balanced market. Does that sound right?
Yeah.
I don't know.
So Anya has a better question. It's not even a question, it's a comment that I want to comment on. So we found out, or she had commented here, that she is in Florida. So she says property taxes and interest are tax deductible. So we've had changes to the tax code. Trump did some things in 2017, went into effect in 2018. Anya being in Florida doesn't have to worry about a state income tax. So her property taxes are not going to be impacted unless she owns the Mar-a-Lago estate by the cap of $10,000 of state and local taxes. So yeah, if you are in Florida, Texas, any of the other wonderful states that have no state income tax, you're going to be able to deduct all of your property taxes. Most of our clients here in California at the prices that we've hit now, if you qualify for a $700,000 house, you are paying enough state tax that you've already hit the cap of 10,000. So your property taxes, for the most part, are no longer deductible, or they're capped. Interest is really interesting. And someone hinted at this earlier, that they were bummed they were going to have to buy an RV or do something else to get some additional tax deductions because they refinanced to such a low rate that their interest deduction is minuscule. Back in the day when we were doing and when I say back in the day, in the 90s, when rates were anywhere from 7.5% to 9.5%, when we would run the numbers and showing someone the benefits of owning versus renting, when rates are at 8% and you're borrowing $200,000, that's $16,000 a year of interest. That's a real deduction there, a big deduction. Now we have standard deductions so large and interest rates so low that if you borrow $500,000 at 3%, it's $15,000. So, and if you're married, your standard deduction is over $24,000. So it may not even make sense to itemize for some people. So it is important. Again, you guys probably get tired of me saying it. Everyone wants to believe that mortgages are simple and you can talk to a kid in the call center and they can walk you through this, but they have no idea. Most of them don't own homes. You call Rocket, most of them you're talking to have never bought a home. They've never borrowed. They don't own a mortgage, own a home. So explaining to you when you will and won't benefit from home ownership in terms of interest and tax deductions, it's beyond the scope of most people. I had a client today.
Hold on one sec. Josh, I'm going to just add this while I have it up on the screen here. So National Association of Realtors lists total current inventory of 1.31 million, so a little bit more than I thought. Historically, we are between 2 and 2.5 million homes. The peak in 2007 was 4 million homes. Right. So context there. We're significantly lower than we were in 2007, significantly lower where we are historically, but quite a bit more than we were just a year ago, 2 years ago. So hopefully that answers your question there. All right. Sorry about that.
No problem. What I was going to say is I have a client, sends me a text yesterday, says, hey, can you please help? We're in the middle of buying an investment property and this lender's charging me through the nose. And I'm kind of shocked, first of all, because we track and we usually get notifications when there's a mortgage inquiry on a client. He had told me he was considering this in the spring. We talked about it and never heard from him. I figured as the market changed, he put it on hold. Well, his mother-in-law is representing him as a realtor. She wanted him to use her lender. The lender gets him way into this, and I said, there's several red flags here about what you're being told. He told my borrower, hey, we sell all of our loans in the secondary market, so I get to set the pricing. So anyone that tells you that, and I get this all the time, probably I don't say all the time, but 4 or 5 times a year, a realtor that I have will say, yeah, this person jumped in my open house and they said, yeah, they can set the pricing anywhere they want on any loan. Well, within reason, they might be able to. And if they lose money on a loan, they have to make it up on another one if they're not the business owner. Business owner could do a loan at a loss. But it flies in the face of logic. every loan, other than a loan that like your local bank or credit union plans to hold and keep on their books with money that they have from depository funds, gets sold in the secondary market. The secondary market, the mortgage bond market, dictates what the yields and returns need to be on that. But long way of saying, we've done a bunch of no-cost refis for him. We helped him with the purchase with no lender fees on that. We didn't charge him any points. He's buying a $230,000 house. There's $7,500 in box A. And of course, he calls me 2 weeks into this. 2 weeks ago, rates were about 0.5% lower, about 2% lower in that. So instead of the 7,400, 7,700, whatever he was paying, we could only get him down to 4,700 and match the rate. So he could have a higher rate. But like everyone wants to commoditize this and say it's push button, get mortgage, all mortgage lenders the same. I can do this. Our industry, 80% of people are worthless. Either don't know what they're doing, don't care about what they're doing, aren't smart to begin with. So it's critical. I'm not the only person in the world that can do a great job on loans. Matt, the mortgage guy, was here earlier. He does a great job for his clients. There are plenty of people who can do a great job. Do not try to commoditize what we do. Jeb was talking about his client earlier today that's talking to his credit union, and his credit union has a spectacular rate. And we're going through it. They can't close in the timeline that they're getting a counter offer for. So we're going through it, and I'm willing to do the deal thin. Good client, it's an easy loan for us to do, a fairly large loan. I can do that at a fairly low profit level. And what I said to him, I said, listen, you're comparing me to something unreasonable, because the terms I have a program that's awesome interest rates. So when we say, he had reached out and told Jeb, hey, I saw that rates, National Mortgage News is 5.78%. You do 5.25 at 0 points or 4.875 at like 1.25 points. His credit unions do 4.875 at 0 points. I said, what you're doing is you have a supermodel sitting there eating dinner with you, and another supermodel with a PhD walked by, and you go, hey, supermodel, I'm going to go chase after that one. Like you everything is looking at on a spectrum. So what I can say is the people that have the most headaches and heartaches, and the texts and calls that I get of people crying literally and figuratively about, hey, this is all screwed up and this isn't the way it was supposed to go. Can you help? Can you fix it? Are almost invariably the people who tried to commoditize it, who said the person who will quote me the lowest terms are going to do the best job for me. You wouldn't make that decision with healthcare, with any number of things. Yet I see people regularly try and say the person that tells them the lowest number is going to be the best service provider for them in terms of their mortgage financing and real estate also.
All right. Josh, step off that stool over there. All right. Esther says, forgive me if this is a silly question, but what exactly is a market crash? People just completely stop buying, and what are the main factors of a crash? So people will never just stop buying. There will always be reasons that people need to move for one reason or another. Some of the examples that we mentioned earlier. But what happens during a market crash? Essentially, prices go down significantly. Why would prices go down significantly? Well, there's only been really one case that most people point back to, and that's 2008. And why did we see such a big decline in prices? It was because people had distressed sales, right? Their homes had gone down in value because there was a lot of inventory out there on the market. Builders had built a lot of homes. There was a 12 and a half month surplus of property at that time. And, it was a huge buyer's market. And so what happened in buyer's market, prices typically go down during that time. Well, what happened is prices decline. A lot of these people purchased their homes with no money to start with, right? A lot of them had low credit scores on top of that. Adjustable rates. So not only were rates adjusting, they weren't able to get into a new loan because lending had tightened up during that period. They were underwater on those mortgages. On top of that, they looked at it and said, I didn't have no skin in the game, right? I didn't put any money down. Hell, my credit's already crap to begin with. I can go rent the house across the street for, less money than it cost me to keep this. I'm just going to go do that. And that's, people just left their properties, and some people stayed in them and fought the courts and so on and so forth. But that's what caused the crash, right? Was values declining significantly. Right now, you've got, the average homeowner has $185,000 in tappable equity. And, people put money down. Credit scores are much higher. I mean, Josh, where's that chart that we talked about earlier today, showing credit scores where the
Keep
majority
keep
of
talking. I'll have it
financing
here in
happen?
2 seconds.
Because I think it's important to note for anybody watching this, thinking, well, now it's exactly like it was last time. No, it's not. It's nothing like that. And I don't want to keep repeating that over and over again, but the lending standards are completely different. And one of the charts that Josh is going to put up here on the screen shows where lenders were focusing the majority of their loans back during that time with regards to credit score versus where the bulk of their loans are today, with regards to credit score. And so as you see this chart here that pops up, that light blue at the top is the best credit scores, right? So if you go
760 plus.
right, so if you go back to Q1 of, Q1 of, hell, just go back to 03, really, and look at where the bulk of the mortgages were concentrated, right? They were between that 620 and 719-ish credit scores, or actually
Yep.
it was a little bit 760 credit scores at that time. And then as you got down into 06, right, less of the higher credit scores, more of that blue at the bottom, which was the really crappy credit scores. And then look where it is today. You have literally none of the dark blue down there, really. And the majority of the people that are getting loans are really high credit scores. So that's what's going to prevent a lot of this from happening. Now, it can't solely prevent it, but typically speaking, when people have good credit, they make better decisions with their money, and that in turn means paying their mortgage. So
I'll try and dig out another chart, Jeb, for next week that shows the default risk by credit scores. At 760%, 760 plus FICO, there is almost a 0% default rate. It's like a 0.01, 0.02% risk of default on a mortgage in normal times. We're not in normal times because people are sitting on great equity with low interest rates. When you get into the 720 to 759, it doubles, but it's still a very low level. 660 to 719 is a fairly wide range because at 660, it's like a 2 or a 3% risk of foreclosure. Right. And at 719, it's still not even up at 1%. But this group, the 620 to 659, is 6, 7, 8% risk of default, and sub 620 is like 13, 14, 15% risk of default. And the crazy thing, again, comparing to the market to now, not only were these people able to get loans, they weren't paying a premium for those loans. They maybe had to take a 228 or a 327 hybrid ARM that was going to adjust on them really quick, but they were getting the same rate as the 760 guy who was getting a 30-year fix with no prepayment penalty. So there were some caveats with it, but they were getting the same terms with almost no money down. So it was a predictable outcome of what we were doing on the lending side.
And on top of that, this is only mortgage originations. That means those that have loans. People here in the chat are talking about cash deals. Yeah, I can't tell you how many cash transactions are out there and that have closed. I mean, there was a number I saw, and I can't remember what the percentage was of how many people own their home free and clear. There's no mortgage on it, and the number was significantly higher than I thought that it was. But it was, I don't know, it was upwards of like 40% or something of people out there have no mortgage at all on their home. So anyway, we talk about this all the time, and I'm tired of beating that drum. So let's go to Elmer. Elmer says, what are my thoughts on the city of Los Angeles moratorium ending? I don't really have any thoughts on Los Angeles moratorium ending. Again, it is what it is. There will be some people that decide to sell their properties, some people that decide to keep them. But understand from a landlord perspective, when you own investment property, you have to do one of two things when you sell that property. You either have to put it into another investment so that you don't get hit with capital gains, and or you sell it and get hit with the capital gains. And here in the state of California, you're going to pay about 50% between state and federal on selling a property on capital gains like that. So are investors so tired of keeping these investment properties that they're willing to take that big of a hit? My guess is probably not. Who it affects is really the really small mom and pop landlords. And yeah, there's going to be some people that put homes on the market, but I don't think it changes much, quite frankly.
You know what?
Josh?
A more interesting spin on this discussion is Florida, which is it's almost an even split between red and blue, so it's sort of a nice balance. But they're pretty reasonable for Southerners down there, and they are considering, two different cities are considering dealing with the affordability crisis by putting rent control in effect. Well, this is again another policy that sounds wonderful, but when you put it into play, what you do is you decrease the quality of the housing stock, you decrease the volume of the housing stock, because who wants to build potential housing when they are limited by the government in terms of what they can charge for it? So any of those policies where we have, like, what are we talking about in 2022, an eviction protection moratorium? Why didn't we have that in 2017? Like, nothing COVID related is impacting these folks. The businesses that are doing the best, imagine if you were someone who got crushed during COVID. You were a hotel worker, you were a server in a restaurant. Those people went from whatever my job is to nothing.
Yeah.
Now go look at what they make. They're 35, 40% pay raises over that time. And they had a period of time where they had government benefits, and rightfully so. They were suffering through no fault of their own. So they had government benefits. They didn't have to pay rent. They didn't have to pay student loans. But in 2022, when you had a 35% pay raise, if you can't afford to pay your rent, there's a problem. And you can't just say, hey, the problem is you, Mr. Landlords, or the government. If the state government here in California says, yeah, we're gonna help, you apply and we'll reimburse the landlord for us not paying. The government stepping in and paying it, or your landlord not being able to get it, is not an option. It's not a matter of being heartless. It's let's figure out what problem we're trying to solve. And again, if we're trying to solve affordability like the folks in Florida are, rent control has never proven to solve affordability, and it decreases the quality of the housing available to the people in those communities. Because if I can only get $1,200 a month rent, I'm not upgrading and improving and keeping that property in tip-top shape.
No, and LA has some of those rent control things going on, and so on and so forth. So I don't know. I don't. It's hard to say what's going to happen at the moment. I mean, the problem with all of this stuff, with COVID relief money, with moratoriums, with student debt relief, is that you set a precedent. You almost set an expectation that when things get crappy, things don't go like they're supposed to go, that you're going to get covered and you're going to be taken care of. That creates more issues, in my opinion, than just letting whatever happen to begin with. Now, this last one was obviously there was a lot going on there, and I understand the reason that they did what they did. But we're getting to a point now where some of these things that are being passed and things being extended. I mean, student loan debt being extended again till December. Come on, really? I mean, we are almost 3 years into this thing, and we're still extending that. I mean, yeah. Again, we could, like Josh said, we could do an entire show on this stuff, and this isn't about politics. It's not about any of that. It's about, again, debt, if you will, and what it creates, and all that good stuff.
The student loan stuff, Jeb, is insanity from this perspective. Why are we forgiving any debt if we haven't solved the problem that is leading students to graduate or not graduate with excessive debt?
Right.
We've changed nothing about the system. It's sort of like if we didn't change any of the mortgage regulations, but then we gave people $100,000 to reduce their mortgage debt. You have to solve the problem. Like, if it were targeted, need-based, I'm open to some sort of relief for student loans, but like I get to see too much of it in forms of borrowers. The ones that just make me cringe, that I hate the most, and I saw in one of the headlines here with Biden's, elderly student loan borrowers too little too late to get $10,000 relief. I have a client a couple of years ago that she's 63 years old, planning to retire at 68. At 63, she got a master's degree that cost her $120,000. She was going to make an extra $8,000 a year for the last 5 years of her career. So for you non-math majors at home, to make $40,000 additional dollars, she took out $120,000 of student loan debt. And this is a teacher who teaches our children. That's not to condemn her, but we have a system where, like, no one would loan you $1 million to buy a $300,000 house. We regularly loan kids and students of all types $150,000 for a degree that's worth about $40,000. So we got to solve the problem before we solve the debt crisis. Because otherwise, if you forgave everyone's debt today, in 15 years, we're back to the same point because we're letting kids go back and do the same craziness. There's no judging the value of a degree. Like, for an example, right now, I have a client. He's got $175,000 of student loans. He's about 30. He makes $200,000 a year. It was a pretty good investment, right? I also had a client a few years ago, has $365,000 of student loans. He makes $60,000 a year. It's all relative. It's an investment in time, money, and energy to get that degree, and we're allowing people to get degrees that will never pay them back.
Agreed. All right, guys. So I think we've answered literally every question at this point. We got some comments in here, but not a lot of questions. So ask us something. Doesn't even have to be housing related.
Fire away.
What do you got? What do you got? Just ask us anything. Let's talk about something. I'm a little bored, quite frankly, tonight. I'm
Jeb, this is still real estate related, and it is just a comment, but there's kind of a question here. Steve Goldstein,
I didn't understand it. That's why I didn't put it up there. I
didn't
know what was
going on. He says currently there's only 2 sales an agent per year in Santa Clara County, and they're seeing 20% reduction in sales volume. Some real estate businesses are going to close up. Well, you're assuming or imagining that this is abnormal, like it wasn't like this for the last 20 years. I started in 1996. I worked in the Century 21 office where I sat at a desk and served those realtors. There were about 40 to 50 realtors in the office. There were about 8 that did business. The other 40 did 1, 2, 3 transactions a year. Many of them were 60 years old, 70 years old, retired cops, retired from other businesses, and they didn't want to stay home, or their wives didn't want them to stay home, or their husbands didn't want them to stay home. So they said, go to the office. Now we're in a different market, Jeb. No one goes to the office, right? It's not a good way to get your retired spouse out of the home, because no one goes to the office. But when you look in Santa Clara County, what's their average, their median price now, Jeb? 1.1, 1.2 million, Santa Clara County?
Probably, at least.
Sell 2 of those a year at a 2.5% commission, you made $50,000. It's not bad for a part-time job. So you're looking at it as though all of those people, that is their thing, and they are pursuing this for a degree and level of success. So you have to kind of understand the context. And the reality, we talk about this being an 80-20 business. It was an 80-20 business 20 years ago, where 20% of the agents did 80% of the volume. We are much closer to 95-5 right now. Even if it's not exactly that agent, it's a team leader that's the rainmaker doing the marketing, and they have 4 or 5 buyers agents, 2 or 3 listing agents that work under them. So the facts of what you're saying there are not incorrect, but I don't think you're getting the whole big picture view of the way this crazy industry works.
Yeah, no, I mean, I think there's 1.5 million agents at the moment, licensed. No, 1.5 million practicing agents at the moment, which is like the most ever, right? Where there's like actually 3 million people that have a real estate license, something crazy like that. But out of those 1.5 million that are licensed, it's probably, like Josh said, it's probably like 95-5. 95% of those people do, 5% of those people do 95% of the business. So yeah, there will definitely be agents that go out. I was talking to my assistant the other day, like, listen, over the next couple of months, you got to buckle down. You need to save money. You need to do these things, because there's going to be opportunities, but there's also it's going to be difficult for some agents. Some people out there aren't going to make it. So that's just how the business works. It's self-employment, and you got to expect rainy days, right? It's not always going to be sun is shining. But anyhow, let's go on to more positive things. Matty came in his suit and tie. What's he in that? Is it what's
Hey,
going on there? I can't see the picture. He's got
my
the
jug, my
background.
my jug is not even that big, by the way. It's not even
Dude, what
that
is
big.
that thing? Why are you drinking out of that,
It's a
bro?
40-ounce cooler.
Bro, are you that guy that brings his milk jug to the gym so he can show everybody he's drinking water?
Hydrating.
Yeah, that's it. Thanks, Matt, for the super chat. I'll take that $10 and buy pizza with it, not a water. But thank you. Actually, you know what? Next week I'm going to show up with a water jug. See, I actually have a water jug over here. It's not as big as Josh's, but
That's not a water jug. That's a water jug.
I don't even use it, right? I'd rather just drink water out of a water bottle. That's it.
And Jeb, a little known and interesting fact or uninteresting fact about Jeb is he's the one of the weirdos that likes room temp water instead of nice cold refrigerated water.
Absolutely. Here's a good question. Patrick says, how did you get started in real estate? So this is an interesting question. So I came from North Carolina in 2002 to California. Some people that so I dated a girl in college that was from California. That's how I ended up in California. And her family knew some people in a mortgage business. They ran, a big branch operation here back in 2002 ish. They had been running it for a couple of years. And so I went on there in sales. I knew I was a computer science major, but knew I wanted to do something in sales. Had no idea, knew nothing about mortgage, knew nothing about real estate, but guess what? They hired me, just like every other company does when it comes to these businesses, and got started on the loan side, did loans, realized pretty quickly that pretty easy to succeed in this business because most of these people are idiots, and they still are. Sorry if I'm hurting someone's feelings.
It doesn't change.
The barrier to entry is pretty low in this business. So all you got to do is work a little bit harder, know a little bit more, all of that good stuff. So over that course of time, I was doing loans, real estate here and there. I really started to do a lot of real estate and transition into real estate during the housing debacle because I had some opportunities to start selling foreclosed properties through some connections at Fannie Mae that put me with the ability to start selling properties for Wells Fargo and Bank of America and all of these guys. And so that time I was doing both simultaneously, mortgage and real estate, and realized about 2011, 2012, I really hated doing loans just because of what Josh has to deal with on a daily basis. And so said, you know what, I'm done, going to go into real estate full time. And that's when I really transitioned 100% into real estate because I started disliking what I was doing on the mortgage side. And so ever since then, I've been full-time real estate, doing no loans, just referring those out to Josh and so on and so forth. So anyway, that's where we are.
And it is,
there's obviously a lot of detail there that's missing, but that's
Jeb's right that he probably made the right decision. If I were to say which one is a more fun or enjoyable job, it's probably their end. We deal with more headaches, but we probably have a little bit more control over our problems, not nearly as much as I would like, but Jeb has to deal with a bad lender not closing, a seller not performing, an agent disappearing when they have an offer in and you're expecting an offer back. So there's headaches and hassles to both sides. And the biggest thing is low barriers to entry, large potential incomes. So you deal with a ton of knuckleheads on both sides.
No, good stuff. Let's see here. We got an update from Orange Pulp saying seller is saying no deal, can't sell until 2 years after I buy. My agent says if I don't intend to sell, just do it. But I don't know if I feel comfortable. So I get it. I understand your hesitation there. You don't want to be tied into something, not being able to do something. I don't know. I mean, I would say what's the case that this guy actually comes back and does a lawsuit? What's the actual what's the word I'm looking for, Josh? Damages. What are the damages in something like this? I don't know, right? I think you gotta
to enforce it. It has to come down to a deed restriction. So before you walk, what I would say is go to the title company and ask them, are you going to insure this if he puts this deed restriction in place? And go to your lender and say, will you lend with this deed restriction in place? I don't believe that you or any other borrower are going to be able to get a loan with that deed restriction in place. We always have to get deed restrictions approved. Jeb, the big one we have here in Huntington Beach, the inclusionary housing project over there, the city says it has to go to someone of 80% or 100% of the area median income, and there's a max calculation of what they can be asked to pay for the property. So with that, the lenders have to decide, when there's a deed restriction that goes for the next 10, 20, 30 years that says this home can only be sold for X, despite the fact that it might be worth 2X that, the lender, if they foreclose, they're in the same situation. They can only sell it for what that
Right.
deed restriction says. So the lender is going to have something to say, and the title companies have something to say. It sounds like you have a seller who believes they are clever, but doesn't understand all of the workings of this. And if you back out, they try and do this to someone else, they're probably going to end up at the same point.
Yeah, I don't know. I don't know that it's an awful deal. I mean, again, if it's the right property you plan on being there, again, like your agent said, I don't know that it's a problem. But I understand the hesitation. So you just got to make the right decision for you. It's not probably not going to be, one size fits all. Let's see here. Ambrose, I'm going to get to some of these questions at the bottom, but these are kind of quick questions. Do you believe there will be more or less inventory in the Southern California market 3 months from now? Less inventory 3 months from now.
A lot or a little bit less?
We're sitting Orange County today. Like Southern California is hard to justify, right? When I think Southern California, crazy enough, I think Orange County, right? People think Southern California, they think LA, San Diego, Orange County, Riverside, San Bernardino, even parts of Ventura and all of that. So I think as a whole, inventory is going to be down. Here in Orange County, we're at 3,800 homes. I could see it back in, low 3,000s somewhere. I mean, I'm really just taking a stab at it. I mean, we started the year at 954 homes. Peak of 2021, I think we peaked at about 2,700 homes. This year, I think our peak was around 42-ish so far, 4,200 homes. So I don't know. I know it will be less. I think it will be less. I just can't tell you by how much. So. Patrick says, Jeb, Josh, when and how did your paths first cross? So
this is where the fun part of the show starts.
So I actually worked out with Josh's wife back in 2007, 2008 at a gym. We worked out early in the mornings, 5 o'clock in the morning, 5, 6 in the
I
morning.
usually work out before then. So they got there much later.
So 5 in the morning or so, I would work out with his wife. And then on the weekends, we would go in the gym at a more reasonable time. And Josh would occasionally be there on the weekends when he decided to get up, and eventually paths crossed. We were both in the mortgage business at that time. But, just having conversation and what have you. But I don't really think we, maybe 2010-ish is when we really started to hang out, cross paths, all that good stuff. Maybe a little bit before. I don't remember. 2009?
Well, 2009, we went to the games in Aromas. So 2009, yep. Took a little road trip, did some training back before our bodies gave out to learn some the max effort black box training summit. Lots of fun things that Jeb and I did. Fun fact here. My wife said, hey, there's a new guy at the gym who works out with us at 5 in the morning. I think you'll like him. Oh, cool. Tell me a little bit more about him. Well, he's a mortgage guy. And I said, okay, so he's an idiot, right? Because following the 80-20 rule, 80% chance that he's an idiot.
You weren't wrong.
So we meet, and Jeb proves to be much better than expected. But additional fun fact, Jeb is the person that in the middle of a workout, he wants to cheer you on and exhort you to go harder and do better. And I am the person who wants to be in my pain cave by myself. And so one of my best first examples of Jeb is the workout was a 5K on the rower for time. So Jeb finished right about the time I'm starting.
Keep in mind, Josh is about a foot taller than I am. So I'm 5'11". Josh is 6'11".
Jeb 7'12". Jeb finishes his workout, and so for the entire 20 minutes on the rower, I have to hear Jeb telling me I can go harder and do better. And it was all I could do to not get off the rower and choke him out, because literally there's almost nothing in the world you could do to irritate me more than talking to me while I'm suffering.
Fantastic. That's what I do now. I picture Josh working out, and I start having conversations in my head. It's fantastic.
Do you want to tell him about your favorite memory of one of Josh's workouts?
No, that's your shoulder injury. That's, we've
Jeb
told it on here
laughs. Jeb
before.
laughs about watching my shoulder be destroyed to the point that I had to have it replaced at age 49.
I was there when it collapsed. I remember it like it was yesterday, and it does put a smile on my face, Josh. I'm sorry, just the way it went down. Anyhow, let's see where we're at. So I haven't even asked for anybody to like the video. We're at 65. I thought I would try to see if you guys would just come in and do it. No, you failed me. Let's see here. Ambrose again says, are inventory levels a good indicator for home prices? Inventory increases equal price decreases. Yeah, they are. But we're kind of at a weird point in the market where you could add some more inventory, and I don't know that it really changes much because affordability is obviously a problem, right? That's a big driver of people being able to buy houses. But I think what inventory does is it gives people more options, right? So me, for example, if I look at the market today, the right property is not out there, but maybe some more inventory comes to the market and the right property presents itself, which means there's an opportunity for a sale to happen in that case. So inventory is a driver of the market, no question. But at the moment, you're kind of sitting in this weird place where inventory is not really increasing. Buyer demand is kind of about the same level. Homes come on the market, homes are closing. Some homes on the market are coming off because sellers aren't getting their price or deciding not to sell or whatever. Some homes are sitting. And so it's kind of in this weird time in the market, and then you're headed into the fall. So at the moment, a little bit more inventory, I don't think is going to change the market. But at the same time, if inventory dropped by 1,000 homes tomorrow, does that mean prices are going to shoot up? Maybe a little bit. It's this weird transition at the moment, in my opinion, just because of where rates are and people's, the affordability play. What are your thoughts on that, Josh?
Inventory is a measure of supply. Increasing
Right.
supply can absolutely lead to lowering in prices. What we're seeing is leveling off in that increase of supply. If it keeps going up and you don't have an increase in current demand, which would be hard with affordability levels, that would tell us that the price of something would come down. We've kind of gone through the reasons why homes don't exactly work that way, because it's not a stock. I can't sell it and just move into cash and be happy. I have to put a roof over my head for the most part. So people don't sell in the same way. It's one of the reasons why prices are sticky to the upside. But in context, out of context, it wouldn't tell you anything, because what we were saying earlier in the show is demand is decreasing while supply is also at low levels, and kind of there as the supply comes down, it keeps that balance there. So really the measure of absorption, how long it takes for homes to go, is a better measure. So if there's more homes on the market, but they're still going under contract in 60 days, not going to have much impact on prices. But if more homes come on the market and it goes up to 75 and then 90 and then 120 days, absolutely going to lead to lower prices.
Good stuff. This is a good question. Hacker says, thoughts on the possibility of homes not doing much in nominal terms, up or down, but going down in real terms over the course of the next few years. So Josh, you and I have talked about the market's probably got to move sideways for some period of time, 3, 5, 7 years. I mean, potentially, and sideways being up a couple percent, flat, maybe in my opinion, maybe down a couple percent, but more or less kind of in that little trend there. Meaning in nominal terms, not really going up or down. But once adjusted with inflation and the costs that are out there, prices going down. So what are your thoughts on that?
Again, for me, my base case, if you're giving me a bucket to bet on over the next 5 years, and a fairly wide bucket, I'd say 0 to 5%. I think we will see appreciation. I don't think we'll see more than 5% over the next at least 3 years. Out to 5 years is a little bit harder to predict, but say over the next 3 years, 0 to 5% annually. So inflation, depending on your favorite measure, is somewhere in the eights right now. So what are we talking about in real returns? If your house goes up 3%, but inflation was 8%, you lost 5%. I think by the end of 2023, we have inflation in the 3 to 4% range. And I think there's a very good chance that we have home price appreciation in the 3%, 4% range. But say it's 2% and inflation is still at 3.9, you have a nominal loss in the value of your home. So the funny thing is the second time in the last month when we have someone ask about nominal home prices, no one ever thinks, you say no one, almost no one ever thinks of nominal values. They only think of what their real return was. And it's important to think of, but less important than you would imagine. We have appreciation is an important element of how you make money through home ownership. Fixing your house payment over 30 years, or at least the principal and interest component of it, with the potential and option to decrease it over time when interest rate opportunities arise. And then you also have your principal reduction. So despite the fact that nominal prices may be negative, you can still build wealth through that time. If you knew exactly when it was going to happen, yeah, you would step aside and enter back into the market. Most people, once they become a homeowner, they don't want to be a renter again.
Good stuff. Good stuff. Yeah. So cost of building new homes is also a major driver in prices. Sure. Yeah, absolutely. I mean, we saw that last year, right? Lumber costs went up. The margins on those properties went down. So therefore the builders, when they're building these properties, start raising prices so they can get their margin back. And they also knew they had a commodity, that people wanted at that time, being housing, right? Because there was low inventory. But what we're seeing now is the other side of that, right? Some of these have overbuilt and they're having to reduce these properties in order to get them off their books. But understand, builders, there's some huge margins in there. So let's not feel sorry for the builders, but the reality is, yeah, some of these guys are going to take haircuts because of the cost associated, because they're having to back off, their purchase price, reduce price, give credits, that sort of thing.
They have some really good economists working for them. No one could have foreseen what happened over the last few years. But if you've watched commodity prices, this time last year, we were talking about the insane prices of lumber, copper through the roof. All of those things are coming back down. If you look at a chart of lumber, it looks like we're seeing the second part of a double top, and it's likely to come down even more. So hopefully the commodities correct, and that's what it's going to take to see the inflation reduce and come down over the next 6, 12, 18 months.
Got it. Good stuff. So I'm going to ask at the moment that you like the show, if you found any value tonight. I didn't mention earlier, even though Jen put it in there, podcast. So typically we're doing an episode a week on the podcast that is separate from this show. We deep dive into a topic. A lot of you guys have checked it out, given us positive feedback. So go check that out if you haven't done it already. As far as this video goes, we take this, it'll be here obviously on YouTube, but we actually take the audio from it and make that a podcast too. That'll be out on Friday. So typically there's 2 a week on there that you can listen to, audibly, and take in some good housing information if you're still in the market out there to buy, sell, just want to know what's going on. So check that out. And then, Josh.
Jeb, we haven't asked recently in the comments here, or shoot us an email at the email address on the website for the podcast. If there's something you think that would be a good topic, not something just of minimal interest to only you, but something of broad interest that we haven't covered yet that we could cover, we're always looking for ideas of what we could talk about. It doesn't have to be an hour-long conversation, and maybe it's a 15, 20-minute conversation. So if you have any ideas of what you would like to hear us bloviate on for a period of time on the podcast, throw up your ideas.
No, absolutely. And again, what Josh and I think is a good topic might not be something you guys actually care to hear. So that's why it's important to get the feedback, and let us know what you think about it. And lastly, you see that scrolling across the bottom. If you need a lender, you need a real estate agent. In fact, we had somebody recently just close, that reached out and got connected with an agent and closed. So congratulations on that front. So if you need a lender, again, a realtor, there's a link going across the bottom there. All right, Josh Hacker has another question with regards to inflation. How can inflation go down when it appears fiscal policy, government spending conflicts with monetary policy? So, part of this fiscal policy, government spending comes in the form of taxes, right? So, it's part of it is going to be paid back, if you will. So it's not all just free money being thrown out there. Somebody's going to have to pay for it. But at the same time, how does that translate into inflation, Josh?
So it was always thought that government debt was inflationary for the exact reason that Jeb said. You have to repay it. But what happens is, yes, you have to repay it. What does that do? It takes that money away from productive purposes. So it decreases growth. So we're not investing in the economy, which slows growth. The big macro things that are impacting less inflation moving forward and for the last 40 years have led to lower inflation and lower interest rates is aging of our population. So it's growing, but it's growing at a slower rate. The largest cohort is baby boomers at older ages, followed by the millennials. But we have this big cohort that is retiring and they're no longer productive. Productivity for an economy, so GDP is generally population size times their productivity. Productivity just hit like a 40 or 50-year low, the most recent measurement. Population is growing at the slowest rate in 50 or 60 years. And then you have the impacts of technology and globalization. So post-COVID, we've seen globalization reduced. People saw the risks of having things built in China, whether it's important things, things too important to have a country around the globe, or just things too expensive to be subject to how China handled COVID, the last crisis, or how they would handle the next crisis. So you have economies trying to bring production closer to home, which that is slightly inflationary, and that is a permanent change post-COVID that may lead to slightly higher inflation. But again, technology, an aging population, excessive government debt, and having to repay that and taking money away from productive purposes, all these things are deflationary over the long haul. So you're absolutely not wrong when we say that one of the big drivers of inflation was the stimulus. Government borrowed $4 or $5 trillion and gave it away indiscriminately to people that didn't need it, as well as people that did. At a time when they didn't foresee that the pandemic was going to shut down supply chains. So we talk about supply and demand all the time. We increase demand by giving money away. We decrease supply due to the constraints on the systems worldwide. So short run, inflation is logical. Long run, not deflation, but disinflationary forces, lower rates of inflation are probably what we should expect.
Good stuff. It is the Hacker and Ambrose show at the moment. What criteria should a prospective home buyer have in order before speaking to a lender? Should you initiate that conversation if you're not fully ready to make a purchase? So, Josh, I'm gonna throw this to Josh in a second. One thing I want to throw out there is that it's important always to talk to a lender as far in advance as you feel comfortable to have that conversation, right? Because it puts you in a position to know what you need to do to be able to buy a house. So even if it's 6 months out, talking to a lender can have that conversation. But here's what I'll say. There's a caveat to that. If you know you have crappy credit, you know you have no money in the bank, there's obviously some things that you need to work on, and I'm not talking to you directly. I'm just taking in general before you probably go into detail in a deep conversation. Now, Josh might say that that's not necessary, but what I do is I know I often hear conversations that Josh is having with people that have no business even thinking about buying a home. So there's certain things that you kind of need to have. You need to have a job. I mean, that's probably a good start before having that conversation. But if you are at that point in your life where you're going to be a homeowner, you're employed, you have some money in the bank, you have credit, yes, it's never too soon. But Josh, what are you going to say?
You know that my answer is it is never too early to have that conversation, and tell the lender up front, listen, I am in the early stages, but I'm looking to build a relationship with someone who can help educate me on the financing side and help me get prepared. So you say, what criteria should you have? I can tell you how my conversations start with a client. If you fill out that form and Jeb connects us, I'm going to reach out and say, hey, nice to meet you. Always like to start this conversation with, What are you looking to accomplish? And what questions do you have for me before we get started? So what does that mean? They say, well, I'm looking to buy in a house. Okay, cool. What area are you interested in? Oh, we're out in San Bernardino. Cool. When you look at open houses or you go on Zillow or Redfin, what do homes that you and your family would be willing to live in go for? Oh, it's about 425. Oh, it's about 625. Okay, cool. And how much do you have available to work with? I only got like $5,000 right now, but I'm saving $1,000 a month. So I'm hoping by this time next year, 17,000. I got some money in a 401k. I have a family gift. So just knowing the parameters, what do I have available? What do I need to get to ballpark in terms of a home that I would be willing to buy? Um, and just the general of your situation. One of the things that Jeb said, and this is not to beat up on anyone who has reached out or may want to reach out. It's never a waste of my time to talk to someone. But when someone calls and they're in Southern California and they say they make $19 an hour and they need to buy a house because they can't afford rent anymore, that's not logical. There are parts of the country where owning can be cheaper than renting. We're not one of those parts of the country. It is always, if your rent is difficult, owning is going to be more difficult. You know, we've had several people here on the show rightfully bemoaning the fact that $100,000 income, they can't buy a house in Orange County. So someone at $19 an hour, that's, you know, $800 a week full time, $40,000 a year. It's not even half of 100,000. So a one bedroom condo in most communities is still going to run you $400,000 with an HOA. So just think in terms of what you want, what you need, and what questions you have, and what your perfect timeline is. I just finished a pre-approval for a guy, but right before we got on the show, came, I believe, from last week's show, and he says we're 4 to 6 months out. And I always want to ask, okay, why? Well, why is it? And it's funny, a lot of times people say that, and then the next week, hey, we want to write an offer. Some of those people say 3 months, and it's a year later, and they haven't done it, but they're telling me they still want to do it. So we don't write anything in stone, but for him, hey, we're moving to a different part of the state. I can work remotely. My partner has not got the authorization. So in the next 3 months, she's either going to get a new job or she's going to get the ability to work remotely for her employer. So cool. Now we know what that time frame is, and I know when to check in with them. I need to make a calendar reminder. I don't remember everyone I talk to, but that's what we do. What does your timeline look like? What has to happen? And we're just going to check in. Hey, you said you wanted to save another $10,000. It's been 3 months. How are you doing? Oh, I haven't saved any money. You know, and if that happens 3 or 4 times over the course of the next year, we know you're never going to become a home buyer. Or we may check in and you go, hey, you know what? My grandpa gave me a $12,000 gift for Christmas. I'm ready to roll. So that's just know what has to happen and where you need to be, but never too early to have that conversation. And I oftentimes tell people our best conversation is the second conversation after I'm able to put some numbers together for you, because the most important thing that you as a buyer want to walk away from the conversation is, what can I qualify for? That's not necessarily what you can afford, but what's the max I can qualify for? If I do that, what does my monthly payment look like? And then how much cash do I have to have available? And if I don't have that, what are my options to get there? So that's really what we want you to walk away from that conversation with. And that's why a realtor wants you to start with that conversation. So when you go to them, you can go, Jeb, I can go up to $600,000. I need to have $28,000 and I'm at 25 right now, and I should have the rest in the next 30 days. That's sort of how that symbiotic relationship between you and me and the realtor works.
Got it. And I kept Ambrose's question on here this whole time because he's got such good hair. Look at the hair on this guy.
Very, very nice.
It's fantastic. Nice hair, Ambrose. Also, Daniel Camacho, a name I haven't seen in a little bit. Daniel and his wife purchased a house about almost a year ago. Actually, it's going to be a little bit more than a year, maybe 14 months at this point, but popped in here. Thank you, Daniel, for showing your face and being here, man. Thank you. So it's that time of the night. We're going to wrap this thing up. Quite frankly, I thought tonight sucked. If you had a question, no offense to you, don't take any offense to it. I just wasn't into it tonight. I don't know if you could tell over here. Hopefully next week is better. Maybe we need to take a couple weeks off. I don't know. Maybe. What do you guys think? Should we take weeks off?
Jeb's a grumpy old man. Well, hey,
no,
Jeb.
Just, tired of beating the horse. He is dead. The horse is dead, Josh.
Well, I don't.
It's not going to crash.
We had a lot of interest. We didn't talk so much about the crash tonight. We had a lot of questions.
I know, but
this
is all about the crash. It's always about the crash.
But it wasn't. We didn't hardly talk about the crash tonight. We talked about a bunch of different stuff.
Anyhow.
Jeb's a cranky old man, in case you guys
That's
haven't
me.
noticed.
Not old, bro. 42, man.
Doesn't
Just
look a day over 54.
just getting to the point where, I can drink, go in public, all that good stuff, Wasn't able to go in public until I was 40, My wife kept me at home.
Anya says it's your headset's fault. It's giving faulty wiring. It's putting negative vibes into your head.
Maybe it's, I'm not even going to go there.
I know we're almost done, but let's throw this out. Something I said, Tim Erickson piped in and gave a perfect example. Here in Minnesota, I just closed August 1st. My rent was $2,160. My mortgage is now $1,800. By the way, if you live in one of those parts of the country, please, dear Jesus, go buy a home.
Yes.
Lots of the country fall into that. So if you are established and have a long time horizon, all the other things we talk about, if you can own for less than it costs to rent, please don't rent.
Agreed. And if you need a lender to have that conversation, there's a link scrolling at the bottom. If you haven't done so already, hit the like, subscribe, check out the podcast, all of that good stuff. Reach out if you have questions. We're here to help. But for now, guys, we are out. Adios.